There are no stupid questions, only stupid answers. That's what people say, but I don't know if that's true because I run into stupid questions all the time. I even contribute some. So here's one. What if everything is in a bubble? Like every financial asset there is in a bubble, and what if it pops? Well, you have to stick around for the stupid answer. So we have all-time highs for gold price again, but we have them happening really on everything. All the major stock indexes are trading at or near all-time highs. We have housing prices that are the highest they've ever been. Bitcoin near all-time highs. And then we have gold. It's right in there as well. Now, I see advice from people saying that it's not gold that's in a bubble, it's just everything else. And only gold or silver is going to save you when that pops. Let's be honest, it's usually silver. Well, does that mean cut everything else? Don't participate in any of these assets making these big runs. Just get out of it all. Get into your metals. Well, I think there might be a little bit more to consider. Before we get back to it, if you're looking for precious metals, hit up SD Bullion. New customers even get gold and silver for spot. That's sdbullion.com/new. And look, you can go that route. I'm no financial advisor. I can't tell you what to do with any level of certainty beyond, say, 50-50. But for me, gold is a balancing asset, not a growth asset. So I buy it to counterbalance my investments. So if they go to hell, I'm not out on the street. So far, I don't think I'm saying anything too crazy. We probably would all agree with that part. So let's get into retirement planning. I know that's kind of a left field thing, but it'll make sense in a minute. Now, some of you're on the other side of this. Bear with me. At a basic level, the goal here is to get to a point where liquid assets grow enough each year that you can withdraw living expenses without ever reducing the value of what you have. I think there's a name for it, but I can't come up with it. It's basically living the dream here. What this means is that if you have $1 million in the market and it's gaining 8% or more each year, well, you should be able to hypothetically withdraw $80,000 annually to cover your expenses without ever eating away at your portfolio's total value. So never eating away at the principal. Now, the quicker you get to that point, the quicker you can comfortably retire, presumably. So you could make an argument to direct all of your available capital toward getting there. So none of this stuff, no gold, just stonks, get your $1 million, pull the ripcord, and you're on easy street. And before you run out and buy your flip-flops and golf carts, just consider the idea of a bubble for a minute. The US stock market in the 90s is a really good example, and some people are comparing what we're seeing right now to what happened in the late 90s. Now, I don't personally agree with that. I think they're a different set of circumstances, but we're just talking about possibilities here. What if the market did crash? Well, what we saw in 2000 was the Dow losing 65% of its value. The NASDAQ lost $1 trillion in stock value in 1 month alone. $1 trillion. Now, if $1 trillion isn't cool, it won't get your attention. Japan is another example. Their market peaked in 1989, and their crash lost 80% of the market value. 80%. And it didn't return to that peak until a few weeks ago, more than 34 years later. So that's a bad run that lasted an entire generation. So look, this is not a dire warning about a stock market bubble. It's just this story building for where I think gold fits in, where it fits in for me. It's the answer to the what if question. What if the market does crash? What if it's just me that crashes? I'm not sure which of those is more likely, probably me. So gold is there as a backup while I'm working to get that never-ending profit machine built up for retirement. If it's not clear, I'm not retired yet. So having X amount of dollars in a portfolio, growing X amount of percent annually to pay for my early bird dinners, my pickleball rackets, golf carts, leisure wear. That's what I'm working toward. And working on that kind of retirement fund means that I'm pretty exposed to any kind of wide-scale crash in the meantime. So a 75% market crash would have a huge impact on me. I would go from feeling like I'm getting near to that to being really nowhere near retiring at all. I'd probably be a Walmart greeter until I'm 100. So from a planning perspective, we have competing factors. You want to make hay while the sun's shining. You want to get those investment gains while you can. And then you want to get the gains out of the system in case it blinks out. Now, here's the interesting part. Gold is up 4.8% so far this year. That's on top of 14% from 2023. So the thing that I'm doing to counterbalance the growth investments is doing better than some of my individual growth investments. And take Apple stock for an example. It's down 12% in the same period of time that gold is up 14%. How do you like them apples? I don't. I don't like those apples at all. Well, luckily, there's more to play in the casino than just Apple stock. So it's not hard to find assets that are growing. The trick here is to know when to get out. Hopefully to have a backup in case it comes to a stop before we're ready. Now, being long on gold means that you have that backup, but it also means that you don't intend to sell. So if gold is in a bubble as well, we're buying it right now at a pretty expensive time. Now, Jerome Powell just mentioned that the Fed is not far from cutting rates. I'm paraphrasing a little bit. I'm cherry picking even more. But gold goes up when that happens. So here's why I'm not worried about gold being expensive. For one, we haven't even gotten to this policy pivot yet. The rate cuts haven't happened, and that's the ramp. Anticipation of the pivot is what's creating the rally right now. Now, there are other factors, of course, but that's the big one. So if I say gold is expensive right now, how do I know it's expensive? I just know that it costs more than it did 12 months ago, but so does everything, except Apple stock. So we could just stack cash, I suppose, get out of everything that seems to be inflating, but at least in my personal case, that doesn't help me get where I want to go, which is Florida, right? Okay, I told you if you'd stick around, I'd give you my stupid answer to the stupid question, what if it all pops? Like all the financial assets. Now, they're not going to all pop at the same time. They're not going to pop in the same way. But what if it all comes crashing down? Now, how would you plan for that? The reason the answer here is stupid is because it's simple. Diversification and balance. If I want to pour capital into the market, I want to counterbalance just in case it pops. Now, gold is my counterbalance. Now, on the flip side of that, gold is not going to allow me that never-ending portfolio return that people like Dave Ramsey talk about. I'm not going to plan for it to kick out 8 to 12% returns every year from here until infinity. So the stupid answer is just to do both. Keep it balanced. Don't go crazy. Spend all your money on the fallback. Don't go crazy and spend all your money on the opportunity. Have both. And I think that seems pretty straightforward. So maybe it's not really stupid at all. Well, let's call it good there. Let us know what you think, whether gold plays a part in your retirement planning, past or future tense, whether you think it's in a bubble, or whether you think maybe it's the only thing not in a bubble. Let us know. And then while you're in the comments, be sure to hit the like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you'd like to see more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.